I got my start in investing back in March of 2020 when I had $10,000 in credit card debt, and my portfolio back then was only worth $3,000. But now, 2 years later, my portfolio is worth $70,000. So today, I'm going to share my story on how I got here and how you can grow your small portfolio. Now, I was never really the most financially savvy person growing up, hence why I had $10,000 in credit card debt. But luckily, I came across some finance YouTubers like Graham Stephan who taught me the importance of having an emergency savings, which would have came in handy earlier before I spent thousands of dollars on a credit card repairing my car because of hail damage. But lesson learned. So the first thing that I did in order to set myself up to grow my portfolio was set up an emergency savings of a few $1,000s. And after that, I started saving up even more cash to invest into the stock market. So I come up with $3,000 in cash to invest into the stock market, and I started just by buying regular stocks. And my timing on this was immaculate because I invested that full $3,000 that had taken me months in order to save up all at one time, literally the Friday before the stock market crash of 2020. After that, the S&P 500 dropped by as much as 30% in only about 6 weeks. Meanwhile, my portfolio dropped from about $3,000 all the way down to $1,800 at one point. But luckily, I had some extra income between my wife and I to where we could afford to invest about $1,000 a month and buy stocks while they were at a discount. And this sounds a lot like what's going on in 2022, where the S&P 500 has dropped by almost 20% since the start of the year. So this has been a long, slow drawdown versus what we saw in March 2020, but this gives us an even better opportunity to start investing because we have more time to buy stocks while they're at a discount. So the first step in growing your small portfolio, take whatever extra income that you have at the end of each month and start investing that into stocks. Now, this is my portfolio and all the stocks that I own, but everybody's going to have a different take on what is the best stock to invest in. So choose whatever stock that you think will do well. Take whatever extra income that you have at the end of each month that you can afford to put into the stock market and start buying into those stocks. And the second step in growing your small portfolio is to start trading options. Options trading is really a skill that you're going to have to develop over time. And everybody trades options differently, but I found the best consistency in making profits through using spread options. So you have credit spreads and then you have debit spreads. With a credit spread, you're going to get paid a credit just like the name suggests, and the way that the strategy works. You're going to start out by either being bullish or bearish for a stock. So if you think a stock is going to go up and you're bullish on it, you're going to use a put credit spread by selling a put option at a strike price you think a stock price will be above on your expiration date. You're going to buy a put option at a lower strike price against it to lower the amount of money that you need in order to put on your trade. Because if you were to just sell that put option, you would need enough money to buy 100 shares of that stock at that strike price. But with a put credit spread, all you're going to need is the difference between your strike prices multiplied by 100. So instead of needing thousands or even tens of thousands of dollars by selling a put option, all you're going to need for a put credit spread is $100 for most stocks. And if you're bearish on a stock, then you could use a call credit spread. And the way that this strategy works, you're going to start out by selling a call option at a strike price you think the stock price will be below on your expiration date. You're going to buy a call option at a higher strike price against it. That way you don't need 100 shares in order to sell that regular call option, because that would be a cover call to where you need 100 shares as collateral, but since you're buying a call option at a higher strike price, that's going to act as your collateral. So again, where you only need the difference between your strike prices, multiply it by 100 in order to put on this trade. So that's credit spreads, and then you have debit spreads where you're going to be paying a debit in order to open your option, just like you would by buying a regular call or a regular put. But with a debit spread, you're going to start out by either being bullish or bearish for a stock, and if you're bullish, think that the stock will go up, you're going to use a call debit spread. You're going to sell a call option at a strike price you think a stock price will be above in your expiration date. You're going to buy a call option at a lower strike price. And the lower your strike price for a call, the more expensive it's going to be. So since we're buying the lower call option, we're going to be paying a debit, which is going to be equal to the difference in the premiums for the lower strike price call option that we're buying, minus the premium that we're receiving for selling the call option at the higher strike price. So that's a call debit spread if you're bullish on a stock, but if you're bearish, you're going to use a put debit spread by selling a put option at a strike price you think a stock price will be below in your expiration date, and then you're going to buy a put option at a higher strike price. Since the higher your strike price for a put, the more expensive it's going to be. We want to make sure that we pay a debit for this, so we're going to buy the more expensive put option. sell the cheaper put option, and we're assuming the stock will be below our strike price on our expiration date. So that's debit spreads, credit spreads. Then you have iron condors, which is basically the combination of a call credit spread and a put credit spread in one. So the way this strategy works, you're going to start by selling a call option at a strike price you think the stock price will be below. You're going to buy a call option at a higher strike price, just like you would with a call credit spread. But then you're going to select a strike price you think stock price will be above in your expiration date. Sell a put option at the strike price, buy a put option at a lower strike price, and you're going to get paid a credit, basically double the amount that you would get from a put credit spread or a call credit spread. But you're betting on the stock trading flat. That's your assumption that the stock isn't going to go up, that it isn't going to go down, but rather it's going to be between the strike prices for your calls and your puts. But if the stock does move above your strike prices for the calls or below your strike prices for the puts, that's when you take on your max loss, which for this strategy as well as credit spread is going to be equal to the difference between your strike prices multiplied by 100 minus the credit that you're getting to open the trade. And then the max loss with a debit spread is going to be the debit that you pay in order to open your spread option. And your max profit for a credit spread and an iron condor is just going to be the credit that you get up front for opening the trade. And then your max profit for a debit spread is going to be equal to the difference between your strike prices multiplied by 100 minus the debit that you're paying in order to open that trade. So that's how spread options work. This is one of my favorite strategies and probably the most consistent strategy that I've found. I maintain around an 85% win rate, mostly using credit spreads. But if you don't really care about consistency so much and you want to make big profits, then you could also consider out of the money options. And the way that this strategy works is you're going to buy a call option at a higher strike price than where the stock is trading, or buy a put option with a lower strike price than where the stock is trading. So those are going to be out of the money options, but the problem with an out of the money option is that if it stays out of the money, then it's going to expire worthless. So this means that you can put thousands of dollars into an out of the money option, and if it expires out of the money, your thousands of dollars will go to zero. So really, you should treat out of the money options kind of like lottery tickets, to where there's a good chance that you're not going to make any money on it, but then there's always the off chance of Target falling by 25% after the earnings report, and if you bought a put option, then you probably made about 1,000%. Again, it's a whole lot like a lottery ticket. You could win a lot of money, but your likelihood is pretty low. So those are two option strategies that you can start using with a small account. And then once you build up your account to where you can afford to put a few $1,000s into trading options, then you might want to consider trading leaps options. And the way this strategy works, you're going to start out by either buying a call or buying a put based on which direction you think the stock is going to go. You're going to set your expiration date for over a year out to give you plenty of time for the stock to go in the direction you chose. And for every dollar that the stock goes up or down, your option is going to move by its delta value. For example, I bought an AMD $45 call for $5,300 that has a 90 delta. So for every dollar that AMD stock goes up, I'm going to be making $90. So that's about a 1.7% return versus just buying the shares. I would get less than a 1% return for every dollar that the stock goes up. So that's the power of leaps options and how they can help build your portfolio even quicker. Hopefully this video was helpful. Thanks for making it all the way to the end, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.